Bill, we got to wake everybody up after a summer press conference. You ancient past, Bill, this is 20, 30 days ago. The great U.S. Treasury bond rout is far from over. What I have not heard today is a discussion about higher interest rates. What is your belief that we could see higher interest rates?
Well, I think the Chair Powell made it very clear in the press conference that he doesn't see the need to go that much further. The very fact that it's sort of meeting now tells you that he thinks that maybe there's one more rate hike, maybe there's no more rate hikes as we go forward. But that's a very different story than what does that mean for the bond market, because bond yields are low relative to short-term interest rates. I think there's a number of reasons why bond yields could move higher. Number one, inflation is probably not going to average 2% over the next 10 years. It's probably going to average a bit higher because the Fed has an asymmetric regime where when they miss inflation to the downside, they try to offset that with misses to the upside, but not the other way around. Also, if you look at the savings investment balance, it's not as favorable now as it was before because we have a lot more investment programs motivated by Biden administration policies. And the savings pool is also affected by the very large fiscal imbalances that the U.S. is likely to run for many, 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 many years. So that implies that perhaps the neutral federal funds rate consistent with neutral monetary policy, a little bit higher than in the past. And then lastly, the risks are two-sided now for the bond market. Before it was all about, I could hold bonds, and if we ended up in a recession and the Fed got stuck at the zero lower bound, the bond market would protect me. But now we're a long way from the zero lower bound. So the risk of getting stuck at the zero lower bound seems very diminished at this point. And the risk of inflation being sticky, I think, remains very relevant to the bond market.
Bill, we had an article at Bloomberg this week, folks. John Authers and Isabel Lee reported on the strategy world and how absolutely it's brutal has been for Wall Street strategists. Bill Dudley lived this at Goldman Sachs years ago. How clear is the Dudley crystal ball right now, Bill? What's the vision you've got? Are you making it up as you go?
Well, I'm a lot less clear now than I was, say, a year and a half ago. I mean, at that point, it was very clear that the Fed was way behind the curve in terms of the need to tighten monetary policy. They were going to have to go to restrictive, and they were going to have to move fast to get there to keep inflation from getting totally out of control. Now they're at a restrictive setting, and so the question is, how high do they have to go to be sufficiently restrictive, and how long do they have to stay there? And I think they've been the economic news has been breaking in a favorable direction in the sense that they're getting quite a bit of disinflation without actually affecting the growth rate very much, or without actually putting a lot of people out of work. I mean, the fact that inflation's come down and the unemployment rate's still 3.6% is really good news from the Fed's perspective. But my own view is, I'm still where I was before. I think the Fed's going to have to be, tighter for longer, and I think they're going to probably emphasize the longer piece. If you look at their forecasts, they don't see inflation getting back to 2% until 2025. So they think the process still has a long way to go, and I agree with them.
Bill, how important do you think it is that essentially this is a Fed no longer giving forward guidance?
Well, I think that's sort of appropriate. If you've gotten in the vicinity of where you think you need to be, and you're uncertain about what's next because you don't know if you've done enough, you don't know much about the long and variable lags of monetary policy, you don't know how financial conditions are going to react to what you say and what you do. I think at that point you don't really want to give forward guidance because the forward guidance is probably going to be misleading as opposed to illuminating. So I think it makes sense for them to talk about going meeting to meeting. The only thing I was a little surprised today was that there wasn't much talk about the long and variable lags of monetary policy and the need to slow down the tightening, the rate of the tightening process. Powell very clearly put the September meeting back on the table, and I was a little surprised by that because the last meeting was all about the need to slow down and go at a slower pace. And now I find out today that September is a live meeting.
Well, and he was actually pretty blunt on that. Someone asked him specifically, how does this jibe with what you said at the previous meeting? And he basically was like, that's all I'm going to say about that. I'm not going to continue. I'm wondering whether you think it's actually more confusing that there wasn't dissent at a time where there clearly is a range of opinions, and we have a Fed chair just reading the same thing over and over again in response to everyone's questions.
Well, the lack of dissent just means that people are pretty comfortable with the general trajectory of where monetary policy is today, and they're happy about the fact that inflation is coming down, and they're happy about the fact that it's coming down without actually having to really push up the unemployment rate a lot, at least at this point. I think what's the problem that Powell has created for himself is, what do you actually do in September? So in September, you're going to have a couple things. If you decide not to hike, what are you going to show in the summary of economic projection? Are you going to show further rate hikes? If you do show further rate hikes, it's going to raise the question of why didn't you do it in September? Just like what we saw at the last meeting. And if you do hike, then the question is, okay, well, why are you going so much quicker now? And do you show further rate hikes in the summary of economic projections after a September rate hike? So I think he's made it very awkward for himself in terms of tying the projections of what's going to happen in the future to what they actually decide to do in September or decide not to do in September in terms of keeping rates unchanged.
Bill,
so
I
think they've created a bit of confusion. I think it would have been better to stick to the story of monetary policy, long and variable lags. At this point, we're close to where we think we need to be. Therefore, we're going to go more slowly. But he definitely put September back on the table. I mean, he basically talked about the fact that we have 2 more employment reports until September. We have 2 more CPI reports before September. So he put the September meeting back on the table more than I would have thought he would have done, given that he talked about the need to go more slowly because of long and variable lags. So I found that a little bit confusing.
Are some people frustrated about this September conversation? Bill, I tried to jump in to end it, but we can carry it on if you want. Barry Knapp wrote in and he said this: questions about whether they hike in September were inane. He went on to say the press conference went poorly, given no questions about fiscal policy working at cross purposes with monetary policy, nor any questions about the deep curve inversion and impact on small banks and the supply of credit. Bill, can we pick up on the first piece just briefly? Whether fiscal policy right now is working at cross purposes with monetary policy. Do you think it is?
Well, I don't think fiscal policy is stimulative right now in the sense of the fiscal impulse, but we have very large chronic budget deficits, and those budget deficits are going to continue as far as the eye can see. So the way that plays out is it means that the demand on the pool of savings is higher because the government is taking down so much of the supply of savings. And over the next year, we're going to see a lot more Treasury supply, right? Now that the debt limit crisis is behind us, the Treasury is going to be ramping up their borrowing needs very, very substantially. And the Federal Reserve is going to continue to sell. Is going to continue to let $900 billion a year of treasuries and mortgage securities throughout. So they've made a tremendous amount of supply, and I think that's going to weigh on the bond market a bit.
Bill, the hallmark of your work at Goldman Sachs ages ago was an optimism about the American economics experiment. The most memorable moment today was Janice Smialek of the New York Times folding in the Barbie movie into a discussion with the chairman of the Federal Reserve about the resiliency of the American economy. To smart guys like you, everybody assembled in the room, everybody in the economics racket, do we just get wrong the resiliency of America?
Well, I think that we have gotten wrong the resiliency of the U.S. consumer. And I think what's driving it is the fact that during the pandemic, there were large fiscal transfers from the federal government to the household sector. And the household sector basically did 3 things with it. So about a third of it was spent, about a third of it was used to pay down debt, and about a third of it was saved. And so coming out of the pandemic, the household balance sheets were in much better shape than they typically are late in the cycle. And I think that's why the U.S. consumer has been pretty resilient. I mean, I think the point that Gina was making was just that, going to Barbie in a theater is a perfect example of discretionary discretionary consumption. People can decide to do that or not decide to do it. It's not sort of a core necessity. And so the fact that the box office for Barbie and Oppenheimer were so good was sort of evidence from her perspective that the consumer still got some life in them.
That's a surveillance movie review right there. You got to ask him, did he go? You got to ask him.
Getting Bill Dudley and on Barbie. Tom, if you want to know, you can find out. Bill, did you watch it over the weekend?
No, I went to Mission Impossible. I haven't gone to Barbie or Oppenheimer. That's on my plans, though.